The MPC's objective is to return inflation to target sustainably. That is, without overshooting the target once persistent disinflationary forces wane. Given those considerations, the MPC intends to set monetary policy to ensure that growth is sufficient to absorb remaining spare capacity in a manner that returns inflation to target in around 2 years and keeps it there in the absence of further shocks. In our judgment, the lower path for bank rate implied by market yields would provide more than adequate support for domestic demand to bring inflation to target even in the face of global weakness. Were bank rate to follow the path, the very gradually rising path implied by market yields, the MPC's best collective judgment is that inflation would slightly exceed the 2% target in 2 years and rise a little further above it, reflecting modest excess demand. The risk to this projection lies slightly to the downside in the first 2 years, reflecting those global factors I outlined at the start, and that's consistent with a market view that may assign some risk to a sharper deterioration in global conditions. Underlying those projections are significant judgments in a number of areas as described in the report. In any of those areas, developments might easily turn out differently with implications for growth and inflation and therefore for the appropriate stance of monetary policy. In reflecting that, there's a range of views amongst MPC members about the balance of risk to inflation relative to the best collective judgment that is presented in this report. But all members agree that, given the likely persistence of the headwinds weighing on the economy, when bank rate does begin to rise, it's expected to do so more gradually and to a lower level than in recent cycles. This guidance is an expectation, not a promise, and the actual path of bank rate will follow over the course of the next few years will depend on economic circumstances.